Welcome back. You're watching The Money Show with me, Kavita Thapiyal. Now, with the cost of seeking premium healthcare rising steadily, people belonging to the low and middle income groups are finding it difficult to keep up with the expenses. In India, there are about 34 insurance companies that offer health insurance policies. Now, these plans offer effective financial backing to cover the expenses incurred in due course of seeking treatment for any illness or accident. But sometimes the affordability of these covers can be a cause of concern. Let's bring on board Aditya Shah, founder, Hercules Advisor, and discuss how you can reduce your health insurance premium. Aditya, good evening and welcome to the show. So today, tips and trips to reduce your health insurance premium. Although it's not recommended, but then it's if you're someone for whom health insurance premium could be a very high budget item, then maybe you need a smart way to buy a health insurance policy and reduce the premium. For all those people who want to renew their health insurance premium now, what's the first tip that's coming from you, Aditya?
And there are a couple of ways that we can really do it. But the point is that makes the health insurance very suboptimal. Those couple of ways could be point number one is if you're going for a personal health insurance, then you can add something known as a deductible. What is a deductible? For example, if you buy a 10 lakh policy with a 25,000 rupee deductible, so what the insurance company is really saying is that the first 25,000 of any claim will be paid by you. So what really then happens is the insurance company, in due for this 25,000 rupees payment, lowers your premium any between 20 to 40%. So that is the first option that we can really use at this stage. Use deductibles of 25,000 or 50,000. But the side effect of this really is on every claim you will pay 25,000 or 50,000, which is not something that is very desired. The first point. The second point is you can buy something known as a policy where there is copay. So what is copay? Copay is that you are sharing some amount of the insurance claim with the insurance company. Let me give you an example. If you have a 2 lakh rupee claim that you have on the health insurance company, and if the health insurance company tells you to have a 20% copay, it means that out of that 2 lakh rupees, 20,000 will come out of your own pocket. And every time you make a claim, 20% has to come out of your pocket. If you really do this, again, the insurance company generally reduce the premium by about 20, 30, 20 to 40%. Again, not desirable because every time you will have to pay out of your own pocket, but something that you can use to reduce the insurance premium that you earn. Then the third option that you have really got is introducing something known as a room rent limit. This is one of the most riskiest limit to introduce into a health insurance policy because your room rent limit does not only apply to the room that you take during hospitalization, but it also applies to the treatment as well as the doctor or the nursing charges that are there. Generally, companies offer 1 or 2% of the sum insured as the room rent limit. If you are able to really adjust in a room rent limit, you will find that the insurer does lower the premium by about 20%. So that is the third option that you can really use. One of the other options that you can really use is rather than buying a personal health insurance cover, you can go and buy something known as a group insurance cover. Again, these policies are issued by banks, and banks in collaboration with health insurance companies issue these policies because there are hundreds of people buying these policies. The risks are spread out, and the underwriting is very simplified, and insurance premium is lower as compared to a normal comprehensive policy. So all of these are situations where if you are forced to lower your health insurance premium. Otherwise, I will not suggest to use any of these. I will suggest to use a comprehensive policy because that takes care of your entire medical.
Exactly. Now, what happens in these kind of, these ways to actually reduce your health insurance premium is even if you're getting the benefit, as Aditya also said in the end, that it's really not recommended for one to have this kind of curtailed cover. It's only when you don't have the enough leeway to buy a comprehensive plan. But then, having said that, what about buying in health insurance at an your age, Aditya, can that really help you reduce your premium because there won't be any age-specific things attached to it, or maybe this can help you get a plan at a lower premium?
Yes, so as young as you buy the health insurance, generally you will not have any pre-existing diseases. So if you don't have a pre-existing disease, for example, the insurer will not apply any loading to your premium, or you will not have a waiting period for any of the diseases that you can really cover. So that's the first point. However, even if you buy young, health insurance premiums rise with point number one with age. Uh, for 35 to 40, the premium is one. Then from 40 to 45, the premium is twice, is another one. Then 45 to 50, the premium is another one. So as time really goes on, you cannot avoid the rising health insurance premium. On top of this, every time the health insurance company takes a premium increase, that also compounds to the increase. For example, during COVID time, health insurance companies were flooded with claims because of which they had to cover for their losses and they started to increase their premium. So net what is really happening here is uh, you buy young, then you can avoid the loading and the pre-existing waiting period. However, you cannot still avoid the rising premium increases, which happen every 5 year period, as well as the hikes in health insurance premium that the companies really take. So net, it's a very difficult situation as time really goes on. Uh, by the time you are 50, 55, 60, health insurance premiums shoot up, and there is no logical solution that you can attach to at this stage.
All right, so these are the steps through which you can lower your health insurance premium. But then we move on, and time to take our viewer queries on the show. And for all those viewers who are watching us and also want to send us your queries, you can WhatsApp us your questions on 865 797 4571. You can also email us your questions on the money show at etnow.tv. So that's the place where we keep waiting for your financial portfolio queries. Okay, first question is from K. Satya Narayan, and he has invested in Aditya Birla Sun Life Equity. He has ABSL Money Manager Growth, Bandhan Flexi Cap. He's got Franklin India Advantage, HDFC Flexi Cap, HDFC Index Fund, Nifty 50 Growth, HDFC Money Market again, ICICI Pru Long Term Equity, Tata Equity Nifty 50 Index, and he's got Tata Equity PE also, Nippon India Index Fund, SBI Consumption Fund, Nippon India Index Fund also. 13 funds as far as I can see, Aditya, and I don't have him on the phone line. I really wanted to understand why this kind of a mix in his portfolio and whether he's been recommending or going through any financial planner. But all said and done, with the limited information that we have, how can you help him?
Ma'am, first of all, the investor must attach his investment to any goal. He's clearly not done that, so that is the first advice that I will want to give. Second advice is there's no requirement of 13 funds inside the portfolio. He's too much over diversified, and he's owning every stock that is available in the market. I will suggest to him not to really do this. Cut down his investments into four funds. The four funds that I have shortlisted is Nippon India Nifty 50 Index Fund, Parak Flexi Cap Fund, Mirai Asset Tax Saver Fund, and Canara Robeco Flexi Cap Fund. So all in all, into these four funds, you should do his SIP. First of all, stop his SIP into all of these funds, then redeem the existing funds and go into all of these funds. 13 funds required, more or less three or four funds does it for him, and be very disciplined and consistent in your investment for at least next 5 to 10 years. You should be okay.
All right, we could have given him an elaborate solution only if we had more details on us, but then we move on. We'll take Prakash's question, Aditya, and he wants to invest 20 lakh in lump sum or through STP over 2 to 3 months, and the period of investment is 3 to 4 years, and he's expecting a return of 15 to 18%. He wants you to draw him down a strategy of specific funds. Expectation of 15 to 18%, do you think that's a lot to expect, and maybe he needs to just tone down his expectation on returns?
Yes, that was the first observation that I really made. Uh, Consistently make 15 to 18% return on a mutual fund will be very, very difficult. I will suggest to tone down the expectation to about 10 to 12%. That is a more realistic expectation that one may really have. So point number one, tone down the expectation to 10 to 12%. Second point is don't invest lump sum, 20 lakhs if you have got, invest over a period of 3 to 6 months. That will be really helpful and that will help you average down any rise or fall that may happen in the market. Since you've asked me for funds, I suggested three funds: Parag Parekh Flexi Cap Fund, UTI Nifty 50 Index Fund, and DSP Quant Fund. Since your time horizon is very short, it's just about 3 to 4 years, it is very imperative to stick to large cap funds or to a flexi cap fund where the volatility in the fund is really less. Stick to large cap fund, have an expectation of about 10 to 12% return, and invest these funds over a period of 3 to 6 months. You should be on.
All right, we move on. Ramesh wants to invest, he is investing in 1,500 in Nippon India. He wants to know if he can continue investing in this mutual fund. Again, we don't have him on the phone line. We don't know what other funds he has in his portfolio, Aditya.
Yes. So what he's done is he's invested in the Nippon India Nifty 50 Index Fund. It is a large cap fund which tracks the Nifty 50 Index. So according to me, if he has a lower risk profile and if he wants low volatility in his portfolio and is satisfied with about 9, 8, 9, 10% return, should be okay, no problem, should continue. And passive strategy is a very good strategy to continue for the large cap funds.
All right. We'll take Sunil Singh's question. And he says that he wants to invest 50 lakhs in 10 years. And he already has Tata Large and Mid in his portfolio, ICICI Large and Mid, Aditya Birla's Flexi Cap, and SBI Small Cap.
So, ma'am, the funds that he has invested in, four funds are there. More or less, he needs to change these funds a little bit so that he, together with a small cap fund, he introduces a little bit of stability inside his portfolio. What I have done is I've introduced SBI Small Cap Fund, Parag Parekh Flexi Cap Fund, and UTI Nifty Next 50 Fund. These are the funds where he's got a Flexi Cap Fund, he's got a Mid Cap Fund, he's got a Small Cap Fund. So net, he needs to split his SIP equally into all of these three investments, and he should be okay. He should increase his SIP because with the current amount of SIP, he will not be able to reach his goal. So he should either increase his SIP by 10%, which is feasible, or try to elongate his goal. Any of the two will really work. But these three funds, together with an increase in SIP, will work.
What should be the approximate increase in his SIP amount?
And 10% every year is something I say I will want to increase by 50%. But looking at the life situation of individuals, it is very hard for individuals to abruptly increase their SIPs. So I generally tend to suggest the clients, if you're able to increase your SIP amounts by 10% or 15%, which seems to be very feasible and very logical, that should be really okay. And try to increase it by 10 to 15% every year, or maybe every second year, if that's logical. But try to increase the message.
The approximate amount, as in if today he wants to, he's advised to increase his SIP, and if he's not able to, obviously he'll do it gradually. But what's the ideal amount that he should be investing for 50 lakhs in 10 years?
Well, he's investing around 13 to 14,000 rupees right now.
Right.
I suggest that he should be investing about 20,000 rupees in order to reach his goal, which is nearly about 40 to 50% higher than the current SIP amount. That's
the figure for Neil, just in case if you happen to see the show, that's the amount, and if you can, then maybe just increase your SIPs. Mr. Sridhar's question we'll take, Aditya, and he says that he's planned to invest in diversified fund for 10 to 15 years time, and he wants to invest 15,000 per month, for which he wants a fund recommendation from you.
So, ma'am, I don't know what the goals for the investor really are and how much money he wants to accumulate over a period of 10 years, 10 to 15 years. Since the investor has said that he wants to go only into diversified funds, I suggested two flexi cap funds where the fund manager has a complete authority to invest, and they are completely diversified across large, mid, and small, as well as across the sector. So, Parag Parekh Flexi Cap Fund and Canara Robeco Flexi Cap Fund, those are the two diversified funds where he can invest in. Consistently doing SIP to these two funds equally split should help the investor.
All right. be all. Thank you so much, Aditya, for being on the show and helping our viewers with their financial portfolio queries today. And we move